All right, let's talk about inflation, specifically how it's quietly eating away at your investments.
You know the advice. Invest for the long haul, put your money in, and just wait.
The whole idea is to let time work its magic, right? Smoothing out the bumps for safe growth.
But what if that long-term strategy isn't actually enough to outrun inflation?
This is something called purchasing power risk. And honestly, every investor needs to get this.
So you have the same number of dollars, but they just don't buy as much anymore.
So what about stashing cash? I mean, it feels safe, right? Well, let's look at the math. Yeah, look at this. When inflation's over 3% and savings pay less than 1%, you're losing. It kind of flips everything on its head. In this world, holding on to cash actually hurts you. Okay, so the stock market's the simple answer, yeah? Well, not so fast. History has something to say.
Take Japan's Nikkei index. It stayed flat for almost 30 years. That's an entire career of waiting.
And hey, don't think it can't happen here. The S&P 500 had its own lost decade too. Between 2000 and 2013, the average annual return, barely over 1%. That's it. So even if your account went up 1%, with 3% inflation, you were still going backwards. And here's the thing, you can't get that time back. And time, that's your most valuable asset. So we need a new playbook, one that focuses less on price and more on cash flow.
Capital gain is just hoping the price goes up. Cash flow, that's what the asset actually produces.
Think about 2008. Real estate prices crashed, but you know what didn't? Rental income. That rent check is cash flow. It kept coming, even when the market for just selling houses died. So what's the big takeaway? It's a total mindset shift in how you approach your money.
The real goal? Find assets where the cash flow actually pays for the loan you took to buy it.
So you have to ask yourself, is your strategy built for real growth or just hoping?